looks like our first question, if I'm not mistaken, comes from Jim. And Jim says, with only the blueprints, so we're going back to this married put discussion on RadioActive Trading. He says, with only the blueprint as a resource, how best to create a trading plan using the blueprint components to bank against buy and hold equities over the long term. Okay, Jim, I don't know if you saw that, but for blueprint owners only, we addressed that in that recent webinar we did just last week for putting your blueprint to work for you. And the idea being is, number one, you have to set the trading plan of what you want for what your targets are. That's going to determine two things. In the blueprint, there is a discussion about using a married put for income as opposed to growth. What do you feel is the strength of the market, and how strong do you feel the market is right now, Jim? Why is that important? Well, because there might be more volatile positions that I might consider using for shorter term trades that offer a good premium. Ernie's using VEEV right now. He's also in Ring Central, RNG, which continues to move up, and he's using it to generate premium with the calls, having a low risk structure. But something that might be more long-term, maybe Winnebago, for example. Pretty big stock, pretty well-known stock. You might expect further growth of 12-15% over the course of the year. Well, in this case, I might not want to use this July put. I want to go further out in time. That's sort of the difference of the two structures you might use inside the married put technique. Income versus long-term holdings. Some of the dividend-paying stocks you might look at for a married put opportunity, those would be longer-term holdings you expect growth with, but you're not expecting something that has more volatility that's bouncing around, which you'd use for income. Overall expectations are 1% to 2% per month, either realized or unrealized return. What do I mean by that? Yandex, been in this for about 25 days. The stock is up 6.8% from where I got into it. I have an unrealized return right now of about 4% in 25 days. That's hitting my goals. I can do 3 income methods on the married put that I'm in right now. I could bulletproof it before earnings coming out in 17 to 20 days, I believe it is. Oh, I'm sorry, 28 days. There it is, 28 days. I could bulletproof it right now, have no risk on the trade going to earnings. I could generate income on this position right now, which would cap the gain, but that gain would expire before earnings on February 14th. What does this have to do with your question? It's because based on my trading plan, what am I willing to give up based on what are my expectations for the portfolio and for my underlying right now? I'm at my target with the 2 new positions of Yandex and Fabrinet for the first 20 days. Those are the ones we opened in December when we were showing, is it time to open how do we open a proper protected stock trade? And is it time for an income method? And at the time they weren't. Right now I could do, and I probably will do something on Monday for the Fusion subscribers for Yandex and Fabrinet as well. However, if the market opens a little bit weak and Yandex pulls back to, let's say, $43 Monday morning, I'm going to do something different. Still be able to close to bulletproof the trade, but do something different. So that's a roundabout way to say, number one, set up your, how do I want to do this? I need a clean screen. Sorry about that, Jim. What I really want is a clean section, and I don't really have a clean section here, so let me just do this. Oh, I know. I'll just pause the screen here for a second, and sorry, folks. Apologize for the subtle coughing there. You're hearing clicking. I'm not changing the screen yet. I'll let you know when I'm doing that. Okay. Here we go. Okay, so in regards to setting up a trading plan, you guys on the right page? You're looking at profit and loss chart. Here's the Yandex married put. I like this field better because it gives me. Now this one has a 7.9%. Mine's about the same, but it's a January 2021 put as opposed to an August. This was the August 46. So it's an 8% risk for August expiration. When I decide to make a trade, what do I want to consider? One, before I make the trade, Jim, what I want to consider. Number one, what are the realistic and proper expectations for this? I'd say minimum 1% to 2% realized or unrealized profit. What's a realized profit? If I'd sold the call on Yandex and it had expired worthless in the first 20 days, that'd be realized. Unrealized means the stock's up about 6.3% or so. I'm at a 3.1, 2.9% gain on the position in the first 20 days, 28 days. That's what I'm expecting, 1 to 2%, 20 to 30 to 20 to 40 days, realized or unrealized return. Okay, that's a reasonable and realistic expectation for a protected structure. Knowing that if the stock falls, unlike a covered call, I'm not going to probably lose. I'm not going to even lose this. If the stock falls, Jim, in the first 20 to 30 days, if it fell 6.6%, I'd probably be only at 2% loss. I'd stomach that very easily as well. Okay, number 2, are you looking at longer-term growth, meaning I wouldn't be using income methods such as income method number 1 right away, something that sells and caps the upside to create a collar like Terry was asking, or am I looking for income where I would be looking for the first opportunity to sell that call right away? Still keeping those goals in mind. And then 3, some of them are probably going to be this and some are this. That's how my portfolio is structured, by the way. I'm going to open some more positions because I closed out 2 today. In any case, going forward now, you've got your realistic targets, and if your targets are a little higher, that's fine. You just got to make sure they're realistic. And you establish if you're looking for growth right now or for income. Protected growth in case the market pulls back, you're hedged and protected perfectly. For income, hey, you can still do income without getting in trouble following the rules in the blueprint, but you're using the married put structure more for income than for a growth. Larger expectation. Now, a trading plan. Well, that's outlined for you in the blueprint, but the first thing I think you're asking is what we covered last week. If I have $20,000, I'm just getting started. Now, I might have a $40,000, $50,000, $60,000 account, but I'm allocating $20,000 to this new idea, this married put structure. Could I just go to that search we were looking at and open the first 4 or 5 trades and allocate the $20,000 right now? No, I would do maybe 1 or 2 today. Then a week or 2 from now, maybe enter a 3rd position. A week later, enter a 4th position. Why? Because now you're 20 days in from the first ones you entered. That's discussed in the blueprint. That's the first checkpoint. Does it feel like the stock's doing what you expected? Is it meeting your expectations? 20 to 40 days in, 3 weeks in. There's also a comment there by Kurt at 6 weeks in is more of a hard decision of, hey, if nothing's happened and the stock hasn't moved or it's dropped 2 to 3% and your sentiment has changed in the first 6 weeks, just close it. Get out with a 1, 1.5%, 2% loss. Move on to something that is looking more professional, looking more growth, I should say. Okay, but I wouldn't open 4 trades right now. I would open 1 or 2, then the next week open 3, the next week, open another one, so 3 total. The next week open another one, and maybe the next week open another one. So at this point, when you're opening these 2 here, you're at the point where you're evaluating the first 3. Are they doing it for you? That's discussed in that blueprint chapter. Not exiting the RPM, but in the before you get into the income methods, it's talked about there. So that's how I would do it. And then essentially every 20 to 30 days is a checkpoint for what's going on. Is this still performing how I expected? Did I do an income method yet? If I did the income method and didn't have to adjust it, what are my plans for the next income method as well? Okay, so this is a longer term growth structure protected in your portfolio. And I mean longer term, even if you're using it for income or using it for growth, you're going to be planning on being in these positions for maybe 3 to 4 months unless one drastically exceeds your expectations or falls out completely. And then you decide, following the rules in that exiting an RPM chapter, is it now time to exit? Is it now time to do something else with that position or move on from there? So those are my thoughts, Jim, on setting up a trading plan from scratch, from start, with the blueprint as your resource. If you have further questions, I encourage you to send them to us via email. And of course, you can also schedule a coaching session, ask to schedule a coaching session to talk with myself or Ernie about how to set up the structure now or how to start trading the married puts now with the blueprint as your resource. Okay, so I'm going to scroll down now. Let's see here. Jerry's question, going back to the married put idea. Jerry states that although I have 90% of my portfolio in married puts, with the market increasing greatly, it seems my overall portfolio does not increase greatly. And instead of going up 3 to 5% per week, I wouldn't expect it to move up 3 to 5% per week, even if the market's doing that, because you've got the hedge in place. I'm thinking 3 to 5% every 20 to 40 days. That's what I usually look for as my first target. And again, following that concept we talked about with trusting the stocks in the RPM report, that video on YouTube that we did, it's I met both of those goals with the Yandex trade and the Fabrinet trade that I opened. Okay, so what you're saying is it only moves up 0.5 or so. Does that seem right? Again, the goal that I look for when I open a married put at first is 3 to 5% in the first 30 days or so, not per week. I don't expect that to grow per week. If the market's growing 3 to 5% per week, I expect to make about 50 to 60% of that. If my stock had moved, like Yandex did, 6% or so, I'm expecting to make 50 to 60% of that movement with the hedge in place. Now, the follow-up to that is that, see, here's that target position. The target graph. Well, we can just talk about that real quick. There was the entry we talked about January 10th was around here for the straddles or strangles, and there's the drop. And then I said the week before that is about at 130. But that's just showing the target position for the earnings straddle and strangle discussion we had at the beginning. All right. Let's just pull up SPY in the last month or so. Okay. All right, so that's the last month. And in the last month, 30-day time period, we've gone from roughly 320 to 332. So 12 points on 320. You know, that puts us at a decent range. What is that? It's just, sorry folks, I'm going to do the math here. 12 divided by 320. I don't want to do it in my head. Okay, 3.5, and that's for 1 month. It's not 3% per week, Jerry. It's 3.5% for the last month. Okay, so I've seen that movement there. And I'd expect, you know, you're saying 0.5 per week. Well, I would expect you would have seen a 1.5 gain in your portfolio, not adjusting the married puts, just in what positions you had from where we started on the 17th of December to the 17th of January. In most cases, that's going to fluctuate. Okay, I have a stock, which one was it? Oh, the Fabrinet one that's actually doing very well for me right now. It's doing better today. Unbelievable. Yesterday when the market was going up, my Fabrinet lost almost 2 points. That's $1.80. It was peaking up at around 66.30. Look at the open, and it's like at 64.20. It dropped $1.80 or something like that. The reason why? It didn't have earnings. It didn't have any negative news. One of its competitors had earnings, and they were pretty bad. So the sector got weak. It pulled it down. Today, it gained that right back up. Okay, it went right back up. It wasn't related to the stock. It was related to a spook fear in that particular sector. Okay, so the stock's still back up, you know, that 3% or so from when I got into it, and it's matching that target. It's time to do potentially an income method on Fabrinet, especially with earnings coming up. Definitely time to do one on the index. Okay, so that's what I'm going to look to do in that position. But related to your question, I'd still expect to see a 1.5% gain. If you saw 3% in the broad market or your stock moved up 2% during the last 30 days, I expect the married put would have gained 1 to maybe 1.5%. And Jerry's follow-up comment to that is important, and that's what I was reading. And Jerry made the comment that, now keep in mind, most of my married puts, or a lot of my married puts, are in higher dividend-paying stocks that are less volatile, which also means they probably have a lower beta, lower movement compared to the action in the S&P 500 and broad market indicators. That is also key. The dividend payment might help make up for that over time, but you're going to see a lower movement, lower volatility, lower beta with those higher dividend-paying stocks. They're much slower growth. Okay, and even in a standard market condition that we're looking at right now. I've had success with dividend-paying stocks, and I had a double-digit gain on Johnson & Johnson over a 10-month period way back when. But the gain was because the stock moved up 8%. Yes, I did income methods along the way. Yes, I collected the dividend. Yes, I held it for 8.5 months, I believe. But if that stock, if Johnson & Johnson had stayed stable, or if it even had just moved up 3% during that time, I would have probably given back equal that 3% in time value decay on the put if I held it for 8 months and made no adjustments. Okay, you have to have the expectation that stock's going to move up. You're doing something very conservative, Jerry, and that's to be applauded. It's a great idea to use the dividend-paying stocks. Personally, the dividend-paying stocks, larger dividend-paying stocks, and by larger, I mean 4%, 3% or more, annualized dividend, that might make up 20% of the married puts that I have open. Now, 20% of my portfolio, 20% of the married puts. So I have 6 married puts open. 2 of them, maybe even 1 of them, are going to be in a dividend-paying stock, but I'm planning on holding that for almost 10 to 12 months like a core holding. I'm not expecting to see the same growth as I am. Again, that goes back to the conversation we just had with Jim related to deciding how much of your structure do you want for growth RPMs to be core holdings on your account versus income. You sound like you're heavily weighted to the growth, which means you are going to have to expect to see lower percentage growth as the market moves up, Jerry. That's just a fact. That's just the way it is. It's the way those stocks behave, I should say. Still might be great opportunities there. And Sam says, yeah, it looks like you're probably using a retirement account. That's exactly right. Okay. And, oh, sorry here. Okay, good. But that's what I would expect. I haven't done an analysis on that in 5 years, so I don't want to say that the analysis I did 5 years ago on being more heavily weighted to higher market cap blue chip dividend paying stocks versus married puts versus growth versus income is still useful for today. I'm probably going to have to revisit that for you blueprint owners in the next month or two just to give a gauge of this. And there's another discussion I really want to bring up with blueprint owners too. It's come up for 3 or 4 questions in the past couple weeks as well. So Jerry, yeah, you're going to expect lower growth. I don't have the beta selected here. All right, here's a good example. This is just the static default married put screen that we use to select. I use to select 90% of the trades. Look at the average volatility here for these positions, 0.32, 31, 28, 35. That's what I look for. We'll call it an average of 0.31. And it's probably higher than that, but let's call it an average of 0.31. What I don't have here selected is beta. So let's see if I can select beta in the columns. I thought it was an available one to look for. Let me click Add or Remove Columns. Look in the stock fields here. Oh, there it is, beta. Okay, it's in the stock selection. It's going to be the last one. I should have moved it next to the other one. I'm sorry about that. All right, so let's take that there. Oh, shoot. Really, really sorry about that. There we go. Okay, now this is harder to see, I know. It's over here. I should have moved it closer. But beta's high is at about 2. There's a 2.28, 1.22. So 1.98, 1.24, 1.89, 1.69. Something's not recording there. 0, so let's ignore that. 1.28 and a 0.94. I'm going to say pretty easy. This is around 1.5 beta, meaning these stocks here in the default married put select. Yeah, I'm not showing it. I'm sorry. There we go. Let's try that again. There we go. There's the beta. Okay, so I added it here. I'm going to correct that. With 1.98, 1.89, 1.2, 2.28, 2.02, I'm going to feel comfortable saying the average beta is around 1.4, 1.5 for the stocks that match the default radioactive trading technique. Now, that being said, let's pull up. Do I have it on this account? Very quickly, let's pull it up. I don't. Shoot. Okay, it's on the other account. Let me change 5 things here. I'm going to change the maximum risk to be between 1 and 5%. I'm going to leave all of that. Technicals. I'm going to drop this to nothing. The volatility. I'm going to put the average stock volume at 750. Fundamentals. Going to leave that where it is, but I'm going to put in a dividend yield of at least 3%. Okay? And I am going to look for, stocks in an uptrend that, let's say at least 0.08 to 0.25. Okay, the volatility. So I changed the volatility of what we'd expect with a dividend-paying stock. Look for higher average stock volume. I'm going to look for a higher market cap. And I'm going to take out the lists. And Jerry, you know this. Why am I taking out the list? Because those higher blue chip dividend stocks are not going to be in the preferred stock list that we use. Do we get what we want? Weyerhaeuser, Vodafone, Bristol-Myers, Blackstone, Archer-Daniels, Starwood, Apollo, MetLife. Yeah, we've got what we want. Why am I doing all this? Look at the numbers. Okay, the volatility, we were at 0.31. Yeah, I did restrict it because those other dividend stocks aren't going to have that higher. But where are we now? 0.9, 0.21, 0.16, 0.22. So the average volatility here is probably around 0.14. It's probably half of the stock volatility that we saw with the ones we look for the movement. Betas, the average is probably around 1.4, 1.5. Here the highest is 1.63. The lowest is 0.55. We're probably looking at more of an average beta here of 1. So that sort of answers your question. So what does that mean? That means, Jerry, if you were just trading the stocks, the dividend-paying stocks you're talking about without the put in place, you might expect to see close to a 1 beta, maybe a little bit less, compared to how SPY, the S&P 500, is moving. With the hedge in place, now we've hedged it with the put properly, but these lower beta, lower volatile stocks, remember, that's going to knock down the beta because of the hedge. So you're probably looking at 0.7, maybe 0.8. With the average beta we had at about 1.5, yes, I'm going to knock that down too, but it's probably going to be at 1.2, 1.3. It's still looking at a stock performance with a beta that's usually slightly higher than the average of SPY. It's going to be more volatile. It's going to fluctuate more, but that's the key. There's nothing wrong with what you're doing, but your assumption is correct that because of the beta factor of those lower volatile stocks with the hedge in place, you're going to see less of a one-to-one movement if you're gauging it against SPY, NDX, and the broad market movements as well. That's just to be expected. That's just the way the market works and the way the hedge structure works as well. Think about it this way. With the regular default married put search, I'm taking higher beta and higher volatile stocks that we know are going to fluctuate in price. Might have a beta of 1.5. But by trading those more volatile stocks with the proper hedge in place, I'm cutting the beta down and cutting the volatility down, so I'm not as affected by those volatility swings down, those volatile swings down and back up. I can still manage to get 50 to 60% of those movements and have more opportunities to apply income methods. When you're starting off with a beta that's closer to 1, stock basket with a beta closer to 1, and then you hedge it to 0.8 or 0.7, now you're going to have to expect, you're already in positions where the volatility of the market sort of hedged out, blue chip, higher dividend paying stocks, less volatile. But now with the hedge in place, you might expect a more shallower growth as the market moves because you've put the beta probably under 1. Beta, again, relationship of the stock movement in relation to the average market movement, looking at S&P 500 mainly as that growth as well. Okay, so that's sort of what we're talking about there in relation to those positions. All right, Ziad, we'll stay on the married put strategy. I've got Ziad 2 questions. I've got Jerry a follow-up question, which we'll get to, that's sort of related to the married puts, and then we'll get right to Mark. Ziad says, isn't the married put strategy a good earnings strategy? I'd rather open a married put before an earnings event, and you'll see me open a couple in Fusion as we go into the earnings cycle, as opposed to a covered call, standard collar position. Definitely, I'm not opening any bull put spreads or bear call credit spreads around earning. So yes, it is something I will do, not as a plan, but I wouldn't have any problem opening any of these married puts that have earnings with 10, 12, 13 days to go. That'd be the most comfortable selection for me, absolutely. Okay, because you have a limited loss on the downside. I believe this should be opened a few days to weeks in advance to avoid buying an expensive put option. Potentially. And sometimes what I might do, Ziad, is use that income method number 12 in the blueprint to open a married put if earnings are less than 10, 12 days away. And then based on what the stock does, adjust that position now to continue it if I'm more bullish. If it just declined, I might just get out of the position and take a profit. If there's a sudden unexpected move down as a married put with income method number 12, I might do that in that scenario. And I'm sorry, so that's one approach I could use with earnings, and you may see that in the Fusion account in the next couple of weeks. A couple of them I might open that way. I did that last year with Dell, as a matter of fact, and it kind of worked out well, and then it didn't. And that was my own fault, sort of. But in any case, yes, to answer your question, married put is probably a great structure to use around earnings. If you don't want to take the risk with a long straddle or a long strangle, you want to potentially buy a stock, but it does have earnings coming up, that's the way to do it. And you could enhance it with a 12, and if there's a movement, you can decide to continue the trade or just get out of it with potentially even a gain on the position.